Hello everyone, let us continue with our discussion. In the previous lecture, we have completed the portion of NPV, that is the net present value. Clear? What we have done in the net present value, we have compared the today's cash outflow with with the present value of future cash inflow. Clear? And if this is greater than the today's cash outflow, NPV is positive, I'll accept the project. I will accept the project. Clear? Now there is one more way to decide whether I should accept the project or not other than NPV. The concept is IRR, internal rate of return. Internal rate of return. Clear? It's like how much you are earning on this given project. Means if today you have invested 100, next year you have received 25, then you have received 50, and then you have received 75. What is the percentage or what is your rate of return in this given project? What is your rate of return in this given project? Means how much you have actually earned in this project in terms of percentage. In terms of percentage, if we can calculate that, suppose I say that, just by an example, I'm not calculating it, just by an example, I say that in this project my rate of return is 15%. What is my cost of capital? 9%. 9% is cost of capital. This is rate of return of this project. Should I accept the project based on the given number? The answer is yes. This was my expectation that I should fulfill this. And what I'm getting? This 15 is your IRR. This 15 is your IRR. This is what you are getting. 15%. What is the minimum rate of return you should get? 9% to actually take the project. Suppose this project cost of capital is 12% and return from this project is coming, say, 10%. Should I accept the project? No. I want this much. How much I got? 10. I want 12%. Required rate of return is 12%. I am getting less than that. Why will I accept the project? I should not accept the project. Clear? So this is another way of actually deciding which project to choose and which project to leave based on their return which they are giving you. So both are lending you at the same page, IRR as well as NPV. They both are lending you at the same page, whether you should invest in this project or not. Clear? One is giving in the absolute terms, that is in the numbers, that this is your NPV. This is your NPV. IRR is giving you in terms of percentage, that this is your percentage. Clear? Sir, can I calculate IRR on my calculator just like I have done it for the NPV? The answer is yes. The answer is yes. So how you will do that? How you will do that it on your calculator? You have to calculate the IRR. Clear? So press CF, second clear work. Clear? Now 100 plus minus, same example which is there on the screen. 100 plus minus, enter, arrow down. 25, enter, double arrow down. 50, enter, double arrow down. 75, enter, double arrow down. Clear? Now you will see C04. Should I press NPV? No. I have to press the button of IRR. I have to press the button of IRR. Clear? And simply press the CPT. Simply press the CPT. Now the answer which you are going to get. Let me remove this one. It's not 15%. What's the actual number? 19.43. 19.43. So I will accept the project. I will accept the project because my IRR, internal rate of return, is greater than the 9% required rate of return. So 9% is my required rate of return. What is the return from the project? 19.4377. 19.4377. Clear? So once anyone have understood the NPV, can easily understand the concept of IRR. The purpose is to think whether I should invest in this project or not. Clear? In a very simple and layman language. Now, over here, author have used a term, or I say a sentence. Okay, write it down, write it down. But once you will read and understand it, because I have explained it in such a beautiful manner, you might not get confused and it's not a new thing for you. But for the sake of understanding, I have to make you write this sentence. Clear? Write down the IRR, internal rate of return. The IRR, internal rate of return, is the discount rate, is the discount rate, is the discount rate that makes the present value, that makes the present value, that makes the present value of a project estimated cash inflow, that makes the present value of the project's estimated cash inflow. So this is the present value of future cash inflows. Okay, equal to the present value of the project's estimated future cash outflows. Now we will use the present value of the outflow as well. Why? Because sometimes it happens that you have paid 100 in the beginning at the 0th point of time. At the one point of time also you have paid 20. So from the second year you have paid 30, but from the third year you are starting generating the revenue. Clear? And you are started generating the revenue from the third year. So you need to take the present value of the outflow as well. Clear? So what is IRR? It is the discount rate at which the present value of the outflow is equals to the present value of the inflow. Clear? Write down. That is IRR is the discount rate. IRR is the discount rate that makes the present value of inflow is equals to the present value of the outflow. IRR is the discount rate that makes the present value of the inflow is equals to the present value of the outflow. Now let us try to understand that what it actually tries to say. It says that if I will discount these three values at the rate of 19.43, if I will discount these three values at the rate of 19.43%, the sum of all will give me the value equals to 100. If you want, you can give a try. 25, 50, 75. Discount it with 19.43. Discount this with 19.43. So if you will take the sum of these three, you are going to get the value of 100. You are going to get the value of 100. Clear? So at IRR, the present value of inflows is equals to the present value of outflows. At IRR, I am not saying at cost of capital or at required rate of return. No, at IRR, present value of the inflow is equals to the present value of the outflow. Clear? So if your IRR is greater than the required return or the cost of capital, I should accept the project. But if IRR is less than the required rate of return, reject the project. Clear? Hopefully you understand this point. Now over here, author have written one more very important point. Clear? It says that if this is a project, okay, this particular project have a cost of capital, or you can say the required rate of return. Clear? And this is the firm, this is a project, and this is a firm. Clear? Now suppose the cost of capital of the whole firm, is say 11%, but for this particular project, the cost of capital came around to be 7%. For this particular project, the cost of capital came about to be 7%. Now you'll ask me the reasons are why. See, sometimes what happens that the firm say this particular firm is risky, but the project which they have taken quite safe. So the money which you will borrow for this particular project will come at a lower cost. Genuine. will come at a lower cost. Why? Because the money which I'm investing in this project, it's safe. It's a well-grown business, high demand among the customers, good payments, good customer base, good supply chain. Project cost risk is less, and hence the cost of the project is less. Now, over here, being a financial manager, I'm in a dilemma. What cost of capital should I choose? Whether should I choose 11%, whether should I choose 7%? So over here, rather than choosing the cost of capital of the project, cost of capital of the firm, I'll go with the hurdle rate. I will go with the hurdle rate. I will go after doing lots of maths and lots of calculation. I'll say that if IRR is above 9%, I will accept the project. Otherwise, I will not accept the project. So this is my hurdle rate. So I'm not going with the cost of capital of the firm with the cost of capital of the project. Clear? If I wish, I can go with the cost of capital of the project. If I wish, I can go with the cost of capital of the firm as well. Clear? But if I don't want both of them, I will choose the hurdle rate. I will choose the hurdle rate. Clear? So if my project's IRR is above my hurdle rate, that is 9%, I will accept the project. Otherwise, I will not accept the project. Very important. Hurdle rate. Clear? I will not accept the project if my IRR is below the 9%. It is below, suppose IRR came out to be 10.15%, 10.15%, which is lower than the cost of capital of the firm, but above my hurdle rate, I will accept the project. Are you getting the point? This concept of hurdle rate is important. Now, very important. If suppose the situation is like this, you are giving negative 100 today, you are receiving $25 after the end of year 1. Clear? You have received another $50 after the end of 1.5 years. Then you have received another $10 after the end of 1.75 years. Then you have received $40 after the end of 2 years, and then you will receive the final money at the end of the 4th year, say $100. Can you use your calculator? No, I cannot use my calculator in this situation. It becomes very difficult to use the calculator. We call this as a unconventional cash flow pattern. Unconventional cash flow pattern. Clear? Or suppose like this, 100, then say negative 70 plus 40, negative 10 plus 80 plus 90, then negative 120. Can I use the calculator? No. I will use the calculator only and only in case of a conventional cash flow pattern. Conventional cash flow pattern where the sign of inflow and outflow changes only once. Only once means from positive it become negative, or from negative it become positive always. Clear? So only once if the sign changes, I will use the calculator. Clear? And the gap between the cash flows also remains the same. Over here they are not same, but over here in our previous example, you see money is coming at the end of every year. So conventional cash flow pattern, I will use the calculator. And if it is not, if it is an unconventional cash flow pattern, I will use the spreadsheets or some models or some systems. Clear? Now we have two different methods, NPV and IRR. Now the point is which method to use. Definitely they will have their own advantages and they will have their own disadvantages. See which one is more straightforward. NPV, clear? It's a direct measure to calculate that expected increase in the value. You have invested 1000 and after 3 years you are receiving say 1545. So directly you can see, okay, there is an increment of $545 in the given period. Clear? Now positive NPV project, okay, it will increase the stock price as well, because you know that if you are investing your money in a project and after 3 years it will increase the cash flow, it will increase the value of the equity, and hence the share price will also increase. So it's a very direct approach, direct method. When it comes to the IRR, okay, it measures the profitability in terms of percentage. Means this is your IRR and suppose 10% is your cost of capital. So you know that 8% is my net profitability in terms of percentage. Clear? Or you can say that on every dollar invested, you are getting 8% return. On every dollar invested, you are earning the return of 8%. Clear? So can I say that it also gives me the information of margin of safety, which is not available with the NPV, that how much return I am actually generating in terms of percentage. Okay, NPV gave me an amount 1545. It's okay. But what is my return, rate of return, which I'm generating actually? That's not visible in case of NPV, but it is visible in case of IRR. Clear? So from the IRR, we can tell that with below this rate, I will not accept the project, and above this rate, I will accept the project. Clear? So that will give me a good idea, good understanding in terms of percentage rather than going in the absolute terms in terms of amounts. Now, there is one more point over here that in NPV 25, 50 and 75. Clear? We assume that over here the cash flow are reinvested. Definitely you are reinvesting this cash flow at what rate? At the rate of 9%. The rate of interest which you have actually put down. Clear? That is the 9%, or you can say the cost of your capital in terms of NPV. But in case of IRR, IRR assumes that this money is invested at the rate of 99.96%. That is the rate of IRR. That is the rate of IRR. Clear? So NPV assumes that the amount is reinvested basically at the rate of return, but IRR invest at the rate of IRR, which is very high. You won't find the projects which is giving you such a very high return. So it's more realistic to use the NPV. It is more realistic to use the NPV rather than going on with the IRR. Clear? And if there is a multiple sign changes, you cannot use IRR, because I have shown you that if this is a situation, if this is the situation, IRR is very difficult to interpret. Clear? If signs are changing multiple time, different cash flow, time flow, so in that situation also R is not suggested. We suggest that go ahead with the method of NPV. We suggest go ahead with the method of NPV. Clear? So this is the concept of IRR. This is the concept of IRR. Once you've understood the concept of NPV easily, you can easily understand the concept of IRR. Clear? I am ending this lecture here and will continue in the next lecture. Thank you.